Now, the party in India supposedly is still happening in terms of private equity exits, if we are just talking about listed equity space. But we are keen to know, Siddharth, what's the overview of what's happening in the global private equities market, if you want to start with.
So obviously, Bangalore after all, so it's always important to start numbers. The global private equity market now is about $13.4 trillion for that matter, with roughly about $3.7 trillion of dry powder still waiting. So this is money sitting with GPs waiting to end up actually getting deployed across the world over there. If you look at the US also as of now as one of the largest markets, and your team's done a fantastic job analyzing that. The greatest absorption of capital is actually happening in the AI and AI-related space, as well as it's actually happening primarily in the US as of now. You've seen almost every large institutional investor across the world end up actually making a beeline to the US, where even now seed rounds, which normally in India goes for about anywhere between 5 to 10 crores on average, there are 50 million, 100 million seed rounds actually happening in the US also, for that matter. And in fact, the term unicorn now has been so technically bankrupted that almost in the US, for that matter, they generate more AI unicorns in a quarter than India has actually generated in the entire year. So it's truly become a fairly wild situation for that. Now, whether the party will end or not is, I think, anyone's guess. I think the US president's also actually goading everyone on, and it's like bargaining in a vegetable market. When Masa from the SoftBank actually came and said, we'll do 500 billion, he's like, make it $1 trillion. He's like, cool, we'll do $1 trillion. So that's the kind of stuff that's actually predicated private equity for that matter. And the reason for that is PE actually becomes the pipeline into your public equities as well. And I think the entire AI story across the world is actually dominated by what's happening in the US in terms of new technology creation, in terms of technology adoption, as well as in terms of funding also. And while AI ends up actually dominating the headline numbers, I think there are very interesting managers that end up actually playing AI adjacent themes as well. So if we look at it, your data centers for that matter, a large number of funds are actually gaining a fantastic amount of capital getting pooled over there. And if you also looked at it, it's not just equity that ends up mattering up here, it's also going to be private credit. I think the dollar yields up anywhere between close to 12 to 14% in dollar terms over there for assets that are for securities that are backed by assets is something that's actually eye-watering. It's somewhat similar to what you get in credit funds in India without any of the opportunity risk that ends up actually coming in. So I think while the public equities end up actually growing, the growth in private equity is far larger, provided I think the important part to notice is it's hard to liquidate any of those investments over time. And hopefully we'll actually speak about some of the things that you need to end up keeping in mind when you underwrite an investment into a private equity firm also.
Got it. I mean, it seems clearly, the scale is not known much in India. What Indians are now kind of driven by, again, coming back to the same point, that every other day there is an IPO and a private equity exit. So now when Indians kind of, consider global private equity funds, obviously one is route, but I think much is talked about today in terms of the routes. Will come to that point. But again, a case for Indians to consider global private equity funds, maybe some headline returns and...
Yeah, of course. From a diversification perspective, I think US is the largest market, and US also, a large number of fund managers there are not geographically restricted to only investing into the US. Unlike in India, for that matter, if you choose an Indian fund manager, regardless of their skill set, their playground ends up actually being India itself. It's impossible for them to end up actually investing into other companies overseas. If you look at the Indian stock market also, Indian startup story also, until recently, 60% of our unicorns are actually foreign-based companies. It took a lot for companies like Grow, Zepto, etc. to re-domicile back to India and go. In fact, the largest private equity exit or largest venture capital exit in the country, which was Flipkart, wasn't of an Indian company. Flipkart was domiciled in Singapore.
Yeah.
So I think these are all the factors that need to end up actually taking into account. So India is actually far smaller in the entire thing in terms of the global pool that's actually there. And if you look at the AI growth story also in India, we pale in comparison to what's actually happening in the US. So if you think about it from an asset allocation perspective, the largest, fastest growing asset class that ends up actually existing is unavailable to a large set of the Indian consumers and the Indian investors who end up actually being there. So global private equity is the only pipeline to end up actually accessing that particular pool. And it becomes a good part of the diversification strategy that any wealth manager or any asset allocator ends up actually keeping.
Got it. So now when it comes to, again, routes that Indian investors can take, we know, obviously we spoke again about the global equities and the routes for that investment. is private equities kind of similar routes, number one. Number two, ticket sizes probably tend to be higher in a private equity investment. Now, given the individual restrictions on LRS, is there a kind of a intelligent way, effective way rather, Indians can think of?
Absolutely. I think in terms of the routes also similar to what you have for your public equities as well. I think it's actually harder for the private route because even if you put a single dollar into a US company, it's unfortunate the way that our FEMA overseas investment rules are written. It's actually classified as ODI and not OPI. So your AD1 banker and the compliance team and all these banks will harass you to the ends of the earth for some of that part. So it's not, my view is that, and this is a personal view, it's not actually worthwhile to do ODI investments using your LRS, especially into private assets. One, the banks do not fully understand half of what they end up actually asking. Two, the banks have not actually read the regulations themselves. I know because I argue with them on a weekly basis on a number of these matters also, for that matter, on behalf of the fund and the portfolio companies. And I think the third part also is the ODI classification makes it such a hassle to end up actually complying with, that even if you end up making a fairly large exit, the ability to get the money back to India and actually file your returns becomes impossible. So therefore, the only viable route that actually exists as of now is to actually run it through pooling structures actually based in jurisdictions like GIFT. Now you have your choice of, normally a large number of these funds end up having block of feeder funds based in Cayman, etc. But I think as all of you people in this room know, the moment you put a Cayman account in your tax return, your client is guaranteed to end up actually getting a tax notice and a full scrutiny for that matter. That's actually one. The second thing is the average, unlike your public equities where every dollar ends up actually having a proportionate share in the distributions and the assets of the fund, private equity is actually driven by the primacy of contract. So you may believe you're, let's say, 5% of a fund, you may actually end up getting 3% of all the distributions that end up actually coming in. It's highly driven by how the fund documents are actually listed. And even your fees, your performance fees, any of the other payments that end up actually coming are actually contingent on the size you end up actually putting in over there. So therefore, what becomes important things to keep in mind. If you're putting in 250K, most managers won't actually look at you. For any sizable, decent fund, the minimum ticket size actually now is about 20 to 25 because they end up raising fund size anywhere between about 400 to about $1 billion for that matter. It's much higher than what you end up actually seeing in India. And for you to be able to get any amount of negotiating power, the larger the fund, the better. But that being said, if you do have a platform play in GIFT, or you do end up actually having feeder funds in GIFT, one, it gives you bargaining power to end up actually working with the managers who are there. I think that's actually number one. Number two, it gives you diversification as a fund of funds into various other private equity funds that end up actually existing. So you are able to curate what you require from that entire piece. Three, it makes compliance a lot easier because the US compliances and what you need to end up actually going through as well as putting it into India is much more different compared to the 64C that we end up actually seeing over here. So even for your clients for that matter, running them through a fund of fund based in GIFT makes it a lot simpler to end up managing, gives you greater bargaining power, makes your compliances a lot more seamless, and also makes it easier for you to end up actually managing your clients. I think a large number of people have actually done these sort of private deals into these companies by themselves, into these funds by themselves, and when it comes to realizing any gains, they face massive issues. So I think a consolidation play is the only way to end up actually accessing private equity players there. One more thing that's important, a large number of global PEs, PE funds are actually looking at Indian investors or Indian LPs. The problem is everyone's aware of this LRS and its 250K for that matter. So the moment anyone over here reaches out to them to say, look, you have a sizable pool of Indian clients, anywhere in the range of about 5 to 20 million, there are a large number of people who will end up actually opening up to you. And a large number of these, given the fact that there are niche funds in the US and other areas also, right, I think just getting that sort of golden gateway out through GIFT is possibly the only way to do it.
Wow. And no, I think GIFT seems to be the best way, considering the FEMA challenges that you said.
Most should way given by RBI and Government of India. So yeah, it is what it is.
Yeah. So when a kind of either an investor or a distributor or an advisor is kind of looking at GIFT City funds, any specific checklist that you would recommend to keep in mind in the diligence part, easy to use?
Yeah, similar to how you would diligence an Indian fund also, just a couple of additional caveats. I think one, given the fact that everything in the US ends up actually being under blue sky, you can't go to the SEC unless the manager ends up actually conducting fraud. Right. There's no ODR mechanism. Everything is actually driven by the fund documents. And since the fund documents are actually written by the managers themselves, they are normally one-sided. So make sure you go through the documents, figure out what the caveats and what the situations are, for that matter, how the fund is governed under various situations, especially if one, the manager decides to leave midway, and number of managers do end up leaving midway through their careers and the fund is actually left in the lurch. I think that's number one. Number two, also for that matter, what the distribution waterfalls end up actually looking like as well. A large number of it is they have the ability to claw back capital, retain distributions without actually giving it out, but they're still liable to end up actually paying tax on those distributions also. So paying tax out of your own equity as opposed to getting money is a problem. It's not a bug in the US or the global PE system. It's actually a feature. The third part ends up actually being this one. Look at the track record of the managers who are there also. A number of them have fantastic returns on paper, but almost no liquidity that ends up actually coming out. And that's actually the biggest thing. IRR is vanity. The only sanity is your distributions. So look at these particular managers who are there also as of now and figure out how much cash have they truly delivered back to your constituents as well, to their investors also. I think these are the three key things to end up actually keeping in mind, for that matter, when you end up actually speaking to your clients also. And lastly, just as a FYI, look at where these investors end up actually investing. There are a number of Indians based in the US who end up actually running US-based funds only to plow all that money back to Indian companies, which is quite frankly a ridiculous way of actually managing that. And a number of them do come to India to try to fundraise over here. Those are not the best funds to end up investing in if you truly want to diversify your asset base. I think everyone here can reach out to any AF in the country to end up actually becoming investors in that.
It's like the bank's end-use certificate. You have to be clear to
more or less. So get clarity on that, because for all the promise of global PE, if your money is actually going out in dollars, coming back in rupees, going to get converted back into dollars and then come back to you in rupees, the currency conversion charge itself will end up actually damaging your returns rather significantly.
Got it. No, Siddharth, this actually you answered the next question, in fact, to a good extent. But I think the specific question I would have will be on tax. Now, on a category 2 tax front, right? Essentially, that's the category that the gift fund will choose, for the private equity funds. Have you seen of late, stability or challenges from a tax risk perspective? Because we're talking about risks. Have you seen any positive, negative developments happen?
It has actually been good. So far, we've gotten the 214 approval. So every asset held by a AIF or a Cat 1, Cat 2 AIF is considered as a security. So you won't have the issue of classification of income as business income or capital gains. Whether the underlying fund holds it on a day basis or holds it over a long period of time, is always going to be capital gains. That's number one. Number two, a large number of the funds overseas also are fiscally transparent. They have the tax pass-through status similar to what we have in India. So it's only the underlying portfolio churn that ends up actually getting taxed onto you. I think that's actually number two. Third part is the instruments that these funds end up actually investing into are primarily preferred stock, similar to CCPS in India, or convertible notes. These are the two most dominant investment forms that are actually there. Convertible notes have a bit of taxation ambiguity in India. Are they taxed as a debenture? Are they taxed as a security? Are they taxed as a loan? Because there's no actual classification of that. So that should hopefully end up actually getting sorted out. Most of the funds worldwide, they won't give you a 64C. They give you a similar kind of form from the US perspective also. That has the same details as the 64C. You just plug it into as though you directly incur those particular expenses, etc. For that. And all this happens from the AF level. The reason why the AF is beneficial is whatever expenses incurred by that particular fund, all of that ends up used to be a dead loss in everyone's hands. But because the units of the fund are also considered, Cat 2 fund are considered securities by themselves. Let's say you put in $100, $20 goes towards expenses. All the 80 is returned back to you. When the $20 is extinguished at the Cat 2 fund level in gift, that becomes a long-term capital loss in your investors' hands also. So that transmission is an advantage given after years of lobbying efforts from the domestic investment side. It's also a concession being given over to the gift funds also. US, I think since the Trump Job Act some TGIA Act or something, Trump Jobs Act of 2017, doesn't allow the pass-through of expenses anymore. India actually, we got pass-through of expenses because of the capital gains and capital asset classification that we had.
Got it. One more tax-related question, I think most relevant for the advisors and distributor community is if we have a NRI client, okay, and they want to still use the GIFT City route to the global private equity, is it a good structure to advise for the distributors?
100%, because even there's an explanation given for all the AIFs, I think from 2014, which says that in case the person is not resident in India and the gains end up coming from an asset not based in India, there are no taxes to be paid in India.
Oh,
So any global income being routed through gift is not actually subject to tax in India. If the person directly made the investment, wouldn't pay tax. If he routes it through a fund in gift, they also don't do
oh yeah, and the category 2 pass-through status actually helps in that argument. So really,
Cat 2 is the ideal way of actually doing it for all intents and purposes because it makes it simpler.
yeah, means
So most of the CAs understand that. The moment they see a US K1, they have no idea what to end up actually doing. So given the fact that the K1, the Cat 2 fund in GIFT can issue a 64C,
Yeah.
this makes it a lot simpler for in terms of compliance.
got it. Now, the final point, Siddharth, is that from a Indian wealth managers, distributors perspective, you obviously work with many of them in India, outside of India. What do you see as the opportunity or the size of the opportunity for them to make it?
So there is a large amount of, so there's interest from both sides. There's interest from larger US funds to get Indian investor exposure. There's a lot of interest from Indian family offices to end up actually investing into these kind of funds. The problem is always in the middle. No one had idea how to end up actually bridging them. So GIFT has actually solved that because one, we have complete clarity from a FEMA perspective how those transactions go through. It's OPI, it's bona fide OPI, money goes in, money can freely end up actually going out. The 81 bankers won't harass you. Taxation also is similar to investing into a domestic fund, so that becomes easier to manage. Third is whatever registrations, US EIN and IRS number, etc., that the fund needs to end up getting, it's easier for them to end up getting it over there. 4 is that I think the manager, a large amount of US tax, thankfully, is actually fairly clear. They don't have the number of amendments and circulars and everything that we end up having. So, and thankfully, as long as Trump ends up being president, they're not going to change anything related to the private equity industry. In fact, I think the Treasury head and some of the people in line for the top jobs in the Treasury department also came from the private equity and private credit industry. So they're not going to end up actually shooting the foot that dropping the ladder that actually got them there. So it's far easier. I think the role for intermediaries now is fantastically large. The US is still not fully aware of GIFT and what to end up actually doing. India has finally got clarity now, but has no idea how to end up managing that. So the list of global funds, etc., most of them are actually available. If you can do your diligence, all of you have friends, etc., in the US, find out about that. A large number of AI funds also are available. There are things like a Prekin, PitchBook, etc., which talk about the funds that are actually raising and what they're doing. It's fairly easy for you guys to go there and actually crack a deal. The good part and bad part is that they don't have a regulator like SEBI to end up stipulating every operational aspect. The bad part is because they don't have someone like SEBI to stipulate all these objects. Even though the fund documents may say something, the side letters end up actually giving a far different. So make sure you have a lawyer with you who has negotiated these fund documents for when you're investing into US, UK or Japanese funds or whatever it is. That makes it a lot simpler for you to end up actually managing.
Got it. So thank you.
These are solved problems. Just speak to the right people to get the right answer.
Right. And any of that kind of platform play is now being built in Gift City where this private equity distribution can converge?
There are people reaching out to GIFT as of now from foreign perspective to do it. But I think for the Indian wealth managers who end up having outfits in GIFT or know a fund management entity in GIFT, the platform play becomes fairly easy to do. Or you can actually collaborate with a fund manager to end up actually using the license to create a fund of funds, and you can end up actually doing that. So I think it's a blank canvas as of now. It just depends on how well you know the players in India, how well you can negotiate with the players in whichever geography it is, and then stitch it together, and there's a large amount of money to be made.
Sure. No, good. Thank you. Thank you for this session, Siddharth.